So many people enjoy the strategy that I talked about in my last video that I've decided to show you a different strategy that can turn $20 into $140 or $200 into $1,400 all within a week's time. That's right, we're going to be talking about how to 7x your money with a small portfolio. And this time around, instead of coming out of pocket to execute my strategy, I'm actually going to receive a credit. I won't have to pay a single dime to initially put the trade into action. Depending on when I plan on deploying strategies or how long I will be deploying them for, it's a great idea to have multiple strategies in my toolbox. So if you haven't already seen it, the last video I made on a different strategy, I'll link it right here. Towards the end of this video, I'll be going over some special considerations that I always keep in mind when deploying today's strategy, so you'll want to stick around. If you're new here, welcome. My name is Ace Hundley. I like to share financial strategies to help you improve your situation. So if you like that, be sure to hit the subscribe button so you don't miss out on future content. So people think that you need a large portfolio to make a lot of money, and I just want to debunk that myth today, because you can actually turn a smaller portfolio into a larger one. It just takes a bit of skill, knowledge, and managing your risk. The combination of all of these things will allow you to grow that small portfolio. If you want to make a ton of money for a small amount of risk, the strategy I'm getting ready to show you might be the one for you, depending on when you choose to deploy it and which stocks you choose to use it on. There's potential for huge amounts of profit while simultaneously limiting your risk. The best time for me to use the strategy is when I think it's highly likely that a stock is not going to rise or fall by much. It's for when I think a stock is going to trade sideways. For visual purposes, I'm going to be showing you today's strategy on 3 different stocks. These stocks are just for illustration. If you do decide to ultimately use a strategy, it'll be up to you to do your own research and decide when to use a strategy and for how long to keep it deployed and on which stocks to use it on. I'm not a financial advisor. You don't have to copy any of this. The goal here is to learn everything that you can and then apply the knowledge to your own choice of stock based off your own assumptions. All right, so the first thing I'm going to show you guys is I'm going to open up Moderna. We'll go right up here to the top here, and we're going to type in ticker symbol MRNA, and then it'll be the first choice here. We'll click on that. And then I'm going to go down to where it says trade Moderna options here. We'll go ahead and click on that. Now you can pick any date you want. I typically go for weekly options. The reason why is because not a whole lot can happen in 1 week's time unless there's an event like earnings or there's a Fed meeting. It's just much easier to bet on a stock going sideways in a given week than for a stock to go sideways for an entire month, such as this February 14th expiration or February 21st. So in this example, I'll leave it January 24th expiration. But pick the expiration date that works best for your assumptions. So now I'm going to be looking at the options chain. This entire thing right here is called an options chain. And again, as an options trader, using today's strategies, it would be because my assumption is that the stock is going to move sideways. So the first thing I'm going to do is I'm going to buy a call option that is 2 strikes above the share price. So the first thing we want to do is come up here and make sure we have buy selected, and we want to make sure that we have call selected. And then we'll come down here to see the share price that Moderna is trading at right now, $35.55. And we can go up 1 strike and we'll be at the 36. We don't want that one right now. We want to go 2 strikes above the share price. So that brings us to $36.50 strike. And if we come over here to the right, we can see the cost to purchase that. It says 23 cents. So we'll go ahead and click the plus symbol right here. And we're not done deploying the strategy yet, but you'll notice immediately on the top right hand corner over here that it costs $23 to open this trade. That's because although it states 23 cents right here, each contract represents 100 shares. So I actually have to multiply this 23 cents by 100 to come up with my actual cost of $23. Next, I'm going to sell a call 1 strike above the share price. So the first step we want to do is come up here to the top. We want to make sure we have the sell button selected, and then we can leave this call just how it is. Then I'll come down here to see, again, the share price is $35.55, and I'll come up 1 strike, which is the $36 strike. And again, we'll come over here. There was a plus sign right next to this 32 cents, and we'll go ahead and click that. Before I click on it, go ahead and pay attention to this word right here. It says total cost. You're going to see that change. So let's go ahead and hit the plus sign and well, bam. It now says total credit, which just means the $32 that I'm about to receive for selling this $36 strike is more than the $23 that I'm about to pay for the 36.50 strike. Therefore, the difference as a credit to me right now so far is $9. Now, I'm not done yet. We're about halfway home. The next thing I'm going to do is sell a put one strike below the share price. So up here at the top, we can leave this on the sell selection, but we want to go ahead and change this to put. So we'll go ahead and click here. I come down and see the share price is right here. And then I'll come down one strike to the $35.50 strike. And then we'll come slide over here to this $1.86 price, and we'll hit the plus symbol right next to it. And when I do that, you'll notice my credit of $9 has now increased to $195 because I will receive an additional $186 from selling that most recent 35.5 strike price. Which brings me to my last step, which is to buy a put two strikes below the share price. So I'm going to come up to the action selector up here and change from sell to buy, and we'll leave the option type on put. I come down to the share price, 35.55, and the strike price below that is 35.50, but we don't want that. We want two strikes below, right? So we'll come down to the next one, which will be the $35 strike. Then we'll go over here where it says $1.51, and we'll go ahead and hit the plus sign to purchase this one. And pay attention over here. So we hit the plus sign, and you'll notice in the top right hand corner, the credit of $195 has been reduced to $44. That's going to be because it cost me $151 for that last purchase. Now that we have all four legs entered, I'm going to go ahead and scroll down, and you guys can see we have a very beautiful chart, and I'm going to explain it right now. If I were to purchase both a call at 36.50 strike for $23 plus a put at the $35 strike for $151, and also sell both a call at the $36 strike for $32 plus a put at the 35.5 strike for $186, if all these numbers match up, then my max loss would be only $6. However, I have the power right now to make a max profit of $44. So if I take my handy calculator here, pull this over here, and let's do some quick math. We'll divide $44 by 6. So you guys can see in this example right here, I can actually 7x my money from $6 to $44. Or if I hit this green continue button right here, I can actually increase the number of times I deploy the strategy. For example, if I can change it from, let's say 1 to 10, you can see down here that as long as I purchase and sell the calls and puts for these dollar amounts right here, then my max loss profit actually balloons up to $440 while risking only $60. The best part about all this is, unlike the strategy that we discussed on Wednesday, the last video I made, when I go to execute this trade, I don't even have to come out with anything out of pocket initially because I'm actually due a credit. Now, obviously, I could go back to the number strategy selector and type in, I could type in 100, I can type in 1,000, and you can imagine what effect that would have on my max profit. But I strongly urge anyone who hasn't deployed this type of strategy before, or someone without a lot of experience executing it, just start off with paper trading at first and then graduate to eventually using the smallest possible amount of actual money on at least your first few go around. Now, again, the assumption here is that the share price of Moderna will stay around, let's see, 35.75 come expiration. So anywhere in this area will make a max profit of $44, anywhere between $35.50 and $36 share price at expiration. And I'm only going to start to lose money on this trade if Moderna trades below $35 come expiration, or trades above $36.44 come expiration. You're just going to collect different varying amounts all through this green profit area here. Even if Moderna is trading as low as, let's say, $35 and let's say 19 cents, I'm still going to double my money, right? Because my max loss was $6. And as you can see, if you look above my mouse to the left, you'll see the expected profit is $13, even if Moderna is trading as low as $35.19. So I'll double my money there. And if Moderna is trading at expiration as high as $36.31, I still double my money. Another advantage this strategy has over the strategy I showed you on the last video is if you take a look at this profit and loss illustration here, you'll notice the triangle shape in the middle doesn't have the sharp point anymore, which just means in order to earn the maximum amount of profit at expiration, the share price does not need to be trading for exactly $35.75. So it's kind of nice. You can see here that the share price can be anywhere in this zone and you'll still get the max profit. Now, the strategies that are the cheapest and give you the highest returns are most of the time neutral strategies. What I mean by neutral is you don't think the stock is going to move much. You think it's going to be trading between a pretty defined range. So in other words, not very volatile. This is a strategy for some of the people that want to aggressively grow their portfolios and have an assumption that a particular stock is not going to move very much. So let's take a look at two more examples. And again, before we do that, the stocks I'm using as these examples are just purely for illustration. In order for me to be profitable over the long term, I would need to perform research to come up with when to deploy the strategy, how long to deploy it for, and ultimately which stocks to choose. So I'll go ahead up here and we'll choose Coinbase, ticker symbol COIN, and we'll go ahead and practice doing the strategy again for you. And again, we'll go around here and click on trade coin options. So we're going to open up 4 legs. The first leg is going to be to buy a call 2 strikes above this share price here in the middle, right? So 2 strikes above would be $300. We'll come over here, click the plus sign. The next step is going to be to sell a call 1 strike above where it's trading at. So we'll go ahead and change the selector here. And we'll leave this alone here. And 1 strike above the share price is going to be 297.5 strike. We'll go ahead and hit the plus sign here. And the third step is going to be to sell a put 1 strike below the share price, right? Share price is right here at 295.27. 1 strike below will be right here, 295. So we're going to go ahead and sell a put, right? For $11.85. And lastly, we're going to go ahead and buy a put 2 strikes below the share price. So we'll go up here, change it to buy. 1 strike below is 295. The second strike below is 292.5. So we'll go ahead and hit the plus sign here. And as you can see, we're going to get paid $222 initially. And that's actually going to be the max profit as well. So as long as Coinbase at expiration is trading between 295 and 297.5, we'll go ahead and keep that max profit. We only start to lose money if Coinbase at expiration is trading below 292.77 or above $299.73. This illustration is going to be valid as long as all these purchases and sales are purchased and sold for these prices. So let's go ahead and try this on a third example. So we'll go ahead and use Meta Platforms, formerly known as Facebook, and with the ticker symbol META. So we'll go ahead and click Meta here. And then we'll go ahead and trade Meta options. All right. So once again, the first step is going to be to buy a call 2 strikes above the share price. So we got the share price right here, 612.71. 2 strikes above is going to be right here, 617.50 strike. We'll come over here to the right and we'll hit this plus sign. That'll be the first step. The second step is going to be to sell a call right above the share price. All right. So that's going to be right here, the 615 strike. We'll come up here, we'll select sell a call, come back down here to the 615 strike, and we'll hit the plus sign here. Then the third step is going to be to sell a put right below the share price. So that'll be one step below this here, which will be the 612 and 50 strike. And we are going to come up here and leave it on sell and change it to put. And then we'll come back down to the 612 and 50 cent strike, which is our third part of this 4-part leg. And we will come over here and hit the plus sign. Lastly, we're going to buy a put 2 strikes below the share price. So the share price 612.71, 2 strikes below will be 610, right? And we want to come up here and change it to buy, and we'll leave it on put. Come back down to the 610 strike price, and we'll hit the plus sign, and voila, we have a total credit of $230 coming to me, which is also the max profit. You can see here, as long as Meta is trading anywhere between 612 and 71 cents to 615 come expiration, which will be January the 24th, that I will actually walk away with $230. Now, if we are trading a little bit lower, let's say about 611 and 27 cents, I will still 5x my money. You see here the max loss is $20 and I'll walk away with 106. So that's a 5x. Same thing over here. If Meta is trading at expiration at 616 and 19 cents, I'll still 5x my money. Now, this strategy I use when I'm seeing that a stock is fixing to start moving sideways. I can really benefit and cash in on a stock not doing too much in the near future. But you want to have your own assumptions using your own choice of stocks based off your own research. When I expect a stock to trend sideways and stay within a certain range, this strategy works phenomenally if my assumptions turn out to be correct. As for the special considerations, we want to keep in mind that some brokers charge commissions for options, so you got to factor those in to see if the strategy still works for you. The other thing is the risk of early assignment. Anytime you sell an option, there's a risk of an assignment. Assignment before expiration date is rare, but it does happen. The most common reason for early assignment is related to dividends. So when choosing a stock to use, take a look at when the ex-dividend date is. If the ex-dividend date is on the week that your options expire, I would either not sell any options that expire that week or close out 2 days before the ex-dividend date to avoid being assigned early and have to deal with all of that. If you also invest in the stock market for the long term, check out this video I made with a simple but very effective 3 ETF portfolio. Or check out this video to see what video YouTube thinks you would prefer. That's going to be it for this video, guys. If you enjoyed it, smash that like button and be sure to subscribe to see more content. I appreciate you guys watching and have a great week. Peace.